Okay, for this mock exercise, we're going to take a look at foreign currency transactions. And we're going to use this question, Manitoba expert. So let's take a look at the question. And we're going to actually do two questions regarding foreign currency transactions. So there's going to be two videos for this particular topic. So let's take a look at the question, first of all. So Manitoba Exports sells Inuit carving to countries throughout the world on December 1st, year 5. This is the date of transaction. They sold 10,000 carvings at a total cost of 600,000 foreign currency units, and the spot rate is 0.71. So let me write that down. So this is December 1st, year 5, spot rate. So I'm going to put the word spot rate, and this is 0.741. And this is one foreign currency for this much Canadian. So this is what we call the direct quote. An example of direct quote. Okay, now, this is the date of sale. I always just like to indicate the various currencies, particularly when I'm doing a foreign currency transaction. Now, the invoice required the foreign wholesaler to remit on April 1st. So April 1st, year 6. That's the date of remittance, so that's the date of payment. And that is, and then December 3rd, year 5, they entered into a forward contract. Okay, so forward contract with the Royal Bank with a 120-day forward rate of 0.781. Hedge accounting is not applied. The fiscal year MEI is December 31st. So that's the year end. And at the year end, on this date, the spot rate is 0.757. And the forward rate is 0.791. And at the payment, the customer, that date is 0.802. And that would also be the same spot rate. That's forward rate. So by virtue of the fact that that's the same date, it should be the same. Okay? So the first question asked us to prepare the journal entries, to record the transaction, the sale, to also record a forward contract, and then we have a year end, so we need to make adjustments. So let me just put that year end here. Okay, and then we also need to provide the transaction on the date of payment. Part B asked us to prepare a partial balance sheet of MEI on December 31st, showing what would the receivables and accounts receivable and associated with the forward contract as well. Okay, so that's essentially the question that we're going to do. Now, to get us started, we want to take a look at what is the accounting for foreign currency transaction. So there's a couple of rules, and the rule says, and this is what we call a two-step transaction, is on the date of the actual transaction, in this case MEI sales, we need to translate the foreign currency to the functional currency at the spot rate. And functional currency means this is the currency in which the organization transacts in. This is where the risk and the decision making in which country, and in our case it would be Canadian dollars. Now, if the transactions happen to be multiple transactions that occurred evenly throughout the year, we often use the average. And in fact, in our standards, it allows us to use the average as the estimate for the individual transaction, foreign exchange on the individual transactions. So the question will say that these transactions occurred evenly, and therefore we're allowed to use the average rate. Now, on reporting, this is when you have a financial statement year-end, and these receivables and payables have not been settled. Then what happens is we need to translate only monetary items at the closing rate. So, for example, if we purchased inventory on account, on the date of transaction, we record inventory debit and credit accounts payable both at the spot rate on the date of transaction. But on December 31st, let's say that's the year end, that's the reporting date, only monetary items are translated at the closing rate. And the closing rate means the balance sheet date rate. Okay? That's what that means. And any non-monetary transactions are translated at the historical rate. Now, what is the definition of monetary and non-monetary? Well, first of all, inventory is non-monetary because the amount of the actual settlement of that inventory is actually not known. In other words, when you finally sell the value of that inventory, it's not going to be known, or we don't know the value. But at least with payables and receivables, those are monetary because it can be translated or equivalent to a cash amount at the settlement date. And that's the difference between the two. Now, if translated non-monetary at fair value, so let's say we looked at our inventory and we did a lower cost and net realizable value, when we realized that the net realizable value of that inventory has gone down, then it says that any fair value items should be translated at the fair value, at the exchange rate, the fair value date. So another example of that is, let's say we have goodwill that we've written down. Let's say we bought a company and we wrote down goodwill. Now, we're going to talk more about translating a foreign operation. But in this case, again, the write-down of goodwill is considered fair valuing the goodwill. So in that case, we would have to also use the foreign exchange rate at the date in which the fair value was determined. Now, once we settle the date, and again, by the way, there'll be foreign exchange gain or loss associated with translating the monetary items at the reporting date, because the exchange rate would have changed. On settlement date, we're going to actually determine how much the related liabilities will now be equivalent to the functional currency, which is in our case Canadian dollars, and we have to translate that liability again at the spot rate in which at the date of settlement and another foreign exchange gain or loss will be calculated. Okay, so let's take a look at this question. So we're asked to do journal entries. So the first journal entry is we're going to record the actual sale. So this is December 1st, year 5. We're going to debit accounts receivable, and I'm going to put the word foreign currency unit and credit sales. And I always like to put the actual calculation right beside the journal entry. And it would be foreign currency unit 600,000 times the spot rate of 0.741. Because this is the direct quote, we're going to multiply it. And that's 444,600. Okay? Now, on December 3rd, year 5, the company executed a forward contract and so what happens is you can see that we're going to be getting 600,000 foreign currency unit. So when you execute a forward contract, you're going to execute a contract that you're going to deliver foreign currency unit to a party who's willing to accept the risk. And normally that's a bank. So in this case, we're going to credit payable to bank. And this is denominated in foreign currency unit. And that is foreign currency unit 600,000 times the forward rate, the forward contract rate, yes. And that's 468,600. And we're going to debit receivable from bank. And this is Canadian dollar. So that's the amount that you're going to get from the bank when you deliver 600,000 foreign currency unit at the date at the end of 120 days. Okay. Now, at December 31st, what happens? That's the year end. What are we going to do? First, we take a look at all our monetary balances, and we're going to translate it at the current rate or the balance sheet date. And in this case, the monetary items is accounts receivable foreign currency. So we're going to take a look. And what happened to the currency? It went from 0.741 to 0.757. So it went up. That means that we're getting more equivalent Canadian dollars in that receivable. So there's a gain. So debit AR, and that's foreign currency unit. And that is foreign currency unit 600,000 times the difference between the current rate 0.757 minus 0.741. And that translates to 9,600. And we're going to credit FX gain. An FX gain is part of regular income. Now, what we need to also do is we need to translate this forward contract. Now, if I was to do a balance sheet as of December 3rd, you'll see that there'll be no effect on the balance sheet because this is an executory contract, and given the fact that the contract hasn't been executed yet, normally commitments you don't record on the balance sheet. So that's why these two are netted. However, at December 31st, the value of this payable to bank has now changed. And now you have a loss because now you've got a forward contract that went up. So you've got 0.781 to 0.791. That means that now that your obligation, that what you're paying to the bank is now higher, larger. Okay? So we're going to debit exchange loss. And that is the difference between foreign currency unit 600,000 times the difference of the forward contract rate, 0.791 minus 0.781. And that gives us 6,000. And we're going to credit the payable to bank. So if you think about it, now my payable to bank is going to be $6,000 higher than my receivable. And at December 31st, you're going to show a net liability. That's what we're going to show on the balance sheet on part B to the question, we're going to show a $6,000 liability called forward contract. What they want you to show is you are now, the contract they executed is now in a liability position, so that when you finally settle, if we were to settle it on December 31st, we'll see that we owe $6,000 more than what we actually are, the equivalent Canadian amount that we're getting for that forward contract. That's really what we're trying to show. Now, let's do the settlement date. So this is now at the settlement date. So at date of settlement, what happens? Well, we're going to translate, we're going to actually reflect the fact that our receivable is now higher because now the exchange went from 0.757 to 0.802. So we're going to debit the accounts receivable in foreign currency unit. And that will be the difference between foreign currency unit, 600,000 times 0.802 minus 0.757. I always like to show my work, okay, as I do these journal entries, and that's 27,000. And I'm going to credit FX gain, 27,000. Now, my forward contract has also increased in its terms of obligation and went from 0.791 to 0.802. So I need to reflect that as well. So this is the accounts receivable, and this is the forward contract. So I'm just going to label this as the forward contract, AR, forward contract, AR, just to show that these are the different transactions, okay, for that particular item. And here, we're going to have a credit to payable to bank, okay, and that is forward contract 600,000 times the difference between 0.802 minus 0.791. And that gives us a $6,600 liability, and we've got an FX loss. Now, finally, we're going to settle this. So we're going to get this AR. So we're going to credit AR, foreign currency unit, and that would be the foreign currency unit at 600,000 times the value of that is 0.802. And if you if you take that, if you just add all of the debits and credits associated with the AR, you'll see that we'll get this number as well. This will be 481,200, and we're going to debit cash for the Canadian equivalent. Now, we're going to debit the payable because now we're going to deliver this cash, this foreign currency unit, and that would be, again, 600,000 times 0.802. And we're going to credit cash in foreign currency unit. The equivalent of that is 481,200 Canadian. Now, remember, we agreed that we were going to get debit cash, the original amount that we agreed to, which is the 468. And credit receivable to banks, receivable from bank. Okay, does that make sense? Now, let's answer part B. Okay, so let's answer part B. So in part B, it's asking us for a partial balance sheet. So we're going to write down the headings, so Manitoba Exporters Inc. Partial balance sheet for the year ended year 5. So we're going to have, under the asset, we're going to have AR. And how much is that? We're going to have AR of $454,200. Now, how did I get that? It's going to be 444,600. Okay, and we're going to add 9,600 to that. So it's 444,600 plus 9,600 gives us 454,200. Now, we do have a liability. Now, the liability, we have a forward contract liability. Because remember, our forward contract is equal when we executed it, but yet at year end, our receivable, sorry, our payable to bank is now higher by 6,000. So you've got payable to bank, $474,600, which is the difference between $468,600 plus the 6,000 less the receivable from bank. And that's the Canadian amount, isn't it? 468,600. And we're only going to show the net. So let me write that down. So only show the net exposure of the forward contract. Okay? So that's what we need to show, only the net exposure. Now, let's calculate I'm going to take this step one step further. Let's figure out what our income statement effect is. So for year 5, what's the gain or loss? Well, we've got a gain here of 9,600. We also have a loss of 6,000. So we have a net gain of 3,600. And for year 6, so for year 6, for the same transaction, what happens? Then we've got a gain of 27,000. We have a loss of 6,600. So what do we have? So we have a net gain, FX gain, of the difference between the two, isn't it? 27,000 less 6,600 gives you 20,400. So the total is an overall gain of 24,000. 24,000 is the overall gain for this. So that's what we're going to show in our income statement. Now, interestingly, how did we know that's the overall gain? If you look at the change, and this is the key, if you look at the change in the forward contract and the spot rate, and that change, okay, so the change in forward contract rate, which is 0.781 minus the spot rate, which is 0.741, that gives you a difference of 0.004 times 600,000 forward currency unit gives you 24,000. So you can actually, so the cost of the executing a forward contract, the cost of it, you can calculate your overall FX gain or loss by taking the difference between the spot rate at the date of which the transaction occurred and the forward rate. And that difference is the cost of the hedge. Right? That's the difference, is the cost of the hedge. And that's what I was trying to show here. And the cost of the hedge is obviously the FX gain. Okay, thank you.